Hey, good morning, everyone. Marty, Missouri here, Friday, the 5th of August, 2022, with your economic update and a quick stock market snapshot. Well, this morning in the written blog, I used one word to characterize today's employment report, and that word was wow, in all caps with an exclamation point. Huge surprise, and we'll get there here in a minute when we talk about the number and some of the related data that came out with it. Nevertheless, in the scoring of our own index, we just dipped right to the zero line. So we're minus 2 points on the week, and that takes us to zero. We've never gone, when we back tested this, we created this back in July of 2017, and it's worked for us quite well since then. But even when we back test it and we look at the indications that it offered up, it would have been a good tool in terms of assessing general conditions. And through those tests, never got below, I want to say 8, without entering recession within a matter of months, and we're at zero right now. So that tells us that recession is clearly looming. As I've expressed here of late, we actually believe at this point that it's not going to be a super harsh one in a historical context. So we'll see how that plays out. Again, today's jobs number was really something to behold. So we'll get to that as we peruse some of our inputs. So we'll start with auto sales. They came out this week and we had just a slight tick higher. Driving by an auto lot yesterday, I just happened to notice there was still quite a bit of vacant slots on the lot, but we are hearing that supply chains for a lot of things are really opening up, and so there clearly, I believe there's more availability and still an impulse to purchase cars out there. Maybe folks who've been waiting are hitting the lots. And again, it's not huge when you look at it in terms of the number, historically speaking, but it's an improvement for the second month running. Consumer confidence remains in the gutter, particularly when we look at the University of Michigan survey and the Langer Weekly Comfort Index. Conference boards is still a little elevated relative to the University of Michigan's, but again, the trend looks like the trend that takes us into recession, which is, as I just expressed, that's our current base case. Initial jobless claims. This is one of the things that makes today's jobs number somewhat confusing. As you can see, they've been ramping up pretty consistently. I think this was the 7th week in a row of rising jobless claims. Still, historically a pretty low level, but the trend is not one that you would welcome if you're concerned about the economy slowing down, right? From whatever level it happens. Once initial jobless claims start rising on a trend basis, we tend to enter recession. Continuing claims popped up a little bit as well. The Institute for Supply Management surveys, hugely important macro indicators. The manufacturing index came out Monday. It dipped a bit. The services survey and index actually popped higher. That was not expected. However, when you really look around, right, people are spending money, people are traveling, people are using services. They bought everything their hearts desired, and there clearly has been a switch from spending on goods to spending on experiences, let's say. And a lot of that did show up in the services ISM, and you're going to see here in the jobs numbers here in a second, or I'm going to express some of the detail, you won't see it on the screen, that the pickup in jobs, we really did see quite the concentration in the services part of the economy. Caterpillar's global sales, they report that when they report earnings now, so we don't get it monthly like we used to, but we get it quarterly, actually declined now. So we're negative, down 4% worldwide in terms of Caterpillar sales. That says something about the state of the economy. Negative 14% in Asia, quarter over quarter. Negative 3% in North America. However, and we're still pretty bullish on Latin America, up 18% in Latin America, down 3% in Europe, Africa, Middle East. So overall, though, this speaks to what look like recessionary conditions to us. as does global purchasing managers indexes. So this is JP Morgan does this. They aggregate the global indexes. Remember last month we were quite encouraged by what we saw here. Drop down to 50.8, drop below 50, and that denotes contraction month over month or recessionary conditions. So pretty noticeable dip in sentiment among the purchasing managers indices or surveys globally. And then last, and of course, certainly not least, the jobs data up 528,000 jobs. The expectation was 250. Unemployment rate was expected to stay at 3.6%. It dipped to 3.5. Average hourly earnings were up 5.2% year over year, almost 0.5% on a monthly basis. The quits rate, I already showed you that. That data came out last week. 2.8 is down, still relatively high. Job openings dipped down from over 11 million for several months to 10,700,000. You can actually argue that the economy, according to this number, created 500,000 new jobs. Obviously, that's 500,000 job openings that are no longer there. So I guess that does make some sense there as well, as instead of necessarily being some negative indicator that companies are not going to be hiring like we previously thought. Well, they actually hired a bunch of people and filled a bunch of those positions. So, folks, when you look at things like I just showed you, the jobless claims data, the overall slowdown, again, the anecdotal indicators, particularly in the tech sector, that they're cutting jobs, pulling back, canceling job openings, that sort of thing, I don't think anybody expected this kind of jobs number. As I mentioned earlier, the service sector, 402,000 jobs across education, health, and leisure/hospitality. Of course, that makes some sense with what we're seeing in terms of all the activity out there. I understand that airports are still just clogged with people traveling and so on and so forth. So as you stop, take a step back, you say, okay, maybe not so surprising that at least relative to the service sector that we have seen jobs pick up, and as people have spent or are finally dipping into those savings after all that money they received around COVID, they're back out there, getting jobs or filling job openings and so forth. It does fly in the face of a weakening economy / recession narrative, but my oh my, it does keep the Fed very much engaged in hiking interest rates and battling inflation going forward. Employment is a big, big deal to them, and this gives them a green light. Now, there's another wow that I have to express right here, at least at this moment as I'm shooting this video, and this is where we'll segue to the stock market. If you'd have told me yesterday, given everything the market's concerned about and what it's been trading on by our estimation over the last month or so, I would have said a 500,000 plus jobs print and everything else that was underneath it would send the S&P 500 down, and the NASDAQ in particular down, 2 to 3% today. And as I talk at you, the S&P is down 0.33% right now. NASDAQ is down, almost 1%, 0.9%. Now, they were down somewhat more than that earlier, but nothing like I just would have expected. Now, the day is young, and it's not unusual for the market that's really trading in one direction with a lot of momentum. I keep bringing up this options positioning among dealers. That was actually quite bullish according to the experts we now paid for their data. That was very bullish coming into this. So there's some real momentum with regard to options going into the third Friday of August, which is options expiration. After that, when we get into that window of time where our technical charts say that we might be thinking about a bottom in this bear market, but that's notably lower than we are right now, particularly after this rally that we've seen. So nevertheless, knowing about this options dealer positioning and all the short interest that's been in there, I am still frankly blown away, at least right now, about today. Although we get into next week and over the weekend and let this get digested, and the realization that those Fed speakers this last week who've been saying the market's getting this wrong, well, this 100% supports that the stock market probably shouldn't be rallying against a Fed that is committed to being really aggressive, at least by recent history standards, with regard to raising interest rates. And another thing that I just don't hear anybody talking about is that beginning next month, they're going to double what we call quantitative tightening, the degree to which they're rolling off their big balance sheet from $47.5 billion a month to $95 billion in a month. And that's just less liquidity for the market to rally on. And it's interesting to me that you're just not hearing a lot about that, at least in the headlines currently. So fascinating stuff. So anyway, so let's look at the technicals, because from a technical perspective, this isn't all that strange, frankly. You get just an instant knee-jerk buy that dip, particularly if buy that dip has been working like it has, for the last month or so. Not to say that, this couldn't be something special. Got to be skeptical right here still, folks. So let's kind of get into it. I'm just going to mess with the 1-year daily chart of the S&P 500 and then the 60-minute chart. So, here we are currently, and this is indeed a rising wedge pattern. Pretty constructive here, though. You don't have your bearish divergences on the daily chart. Remember, though, I did say here the other day, or I'm sure I did because I have this line here, that when you go back to where we bounced off of this, when we were expecting a big bear market rally. Remember, I still have 4,300 as the bear market rally, is about as far as a bear market rally should go here. So we still have some upside here, but we'd have to break through this with some momentum to get there anytime soon. And sure enough, we're bumping right up against that. There's yesterday's, day before yesterday, and then of course today. You break down below this trend line on the daily, you break below that 4,100, and I suspect 4,000 comes pretty rapidly. On the 60-minute chart, this is not a good look. We have this, maybe this bigger channel right here, right, and then we had a rising wedge. This is from last video. And then we did break out of that below. Remember, we had these flat, there's still negative divergences because the market's going higher. We're flat. We were real overbought here on the 60-minute. I drew these earlier this morning. This rising wedge, very, very definite rising wedge. And we're rolling over even more here, folks, on these momentum indicators. So this looks like a pretty good area for traders to short after that breakdown below that. Now, we had that big thrust lower on the news this morning. Makes really good sense, frankly. I'm still blown away. But technically speaking, it makes sense that we come back and, and test the top of that range where we opened this morning. So see, we've been doing that. There's the first hour, second hour, third hour. Right now, we're trying that again. Now, it would not be at all unusual to come back and test the bottom of the trend line underneath this rising wedge here. So this is all within the realm of what you tend to see from a short-term technical perspective, even when the charts are telling you that, probably go lower. So this is going to play out, and I think it's probably going to, at least as I look at the charts. This may be a next week phenomenon. It'd be really, really interesting to see where traders want to go into the weekend. If the market can hold up, and if it can claw back all of today's declines, we actually could very well end the week with a big thrust higher as the options dealers are squaring up and hedging those positions. If, however, we turn back lower and we really break down, if it does happen today, well, then we get a flip in the way they hedge their gamma, and then we could have them having to short positions going in. Of course, that's not the only thing going on. There has been really, really big short interest, as I've been talking about and illustrating for you, on the S&P 500 in the futures pits. We won't know till later today to what degree last week's big rally got rid of that. But today, what an opportunity if these shorts are just sick of the pain they've been feeling as the market's melted higher of late. This morning with that thrust lower, to jump in and cover those shorts. So that may very well be explaining why we're getting some pretty decent action here today as well, in the face of what I'm sure 10 out of 10 analysts would have said would just be really, really bad news for stock traders on a Friday. And the market's 1/3% off right now, just looking at the S&P. So folks, I will leave it there. What a dynamic situation we're facing here on a short-term basis. Longer term, we feel very good about our exposures with anybody who's got a 5-year time horizon right here. Next 5 weeks or months, I'll say it again, it's a flip of a coin, and we want to play some defense along the way. Folks, thank you as always for watching and listening. Hope you have a wonderful weekend. Talk to you next week. Bye-bye.